Hello and welcome to another video on accounting. In this video we will talk about internal controls. Before I explain what internal controls are, let me begin by explaining why businesses need internal controls. Why does fraud happen in the business? Fraud happens because there is an opportunity to commit fraud. An employee in a workplace, for example, sees an opportunity to steal cash because the safe where cash is kept is open. Now, this opportunity and the likelihood of fraud increases if there is no or less monitoring. So, if the employee knows that the safe is not properly monitored, he or she might be tempted to commit fraud. So, to stop opportunities and therefore to prevent fraud, businesses must implement internal controls. Let's look at another example. Now, the aim of accounting is to produce financial statements. These financial statements are used by investors to make their decisions. So these investors should have confidence in the information provided in the financial statements. They should have confidence that there are no inaccuracies in the information given to them and that the financial statements are reliable. Now, to increase the reliability of financial statements and to reduce the errors and inaccuracies, businesses again implement internal controls. One example of internal controls here would be that businesses review their financial statements through an independent auditor, and that is an internal control. We will talk about those later in the video. So what are internal controls? Now that we know the reasons and why we need internal controls, what are internal controls? Internal controls are policies and procedures designed and used by management to achieve three objectives. Number one, to protect company assets. Secondly, they want to report reliable financial statements. And finally, they want to carry out efficient operations. Let's look at the first one, to protect assets. Every business has assets such as cash, equipment, and more increasingly important asset for them is data. They want to protect those assets. So say for example, to protect cash, if businesses have cash on premises, they use safe and they restrict the access to that area where um, cash is kept. So that's an example of internal controls to protect asset. We'll talk more about how we do that. Now, another objective of internal controls is to increase the reliability of financial statements. We have just talked about the fact that investors want to be confident that the info on the financial statements are reliable. That is, there are no inaccuracies. So companies put in place controls such as reviewing these financial statements through an independent audit. There are many examples of companies where fraud has happened, which resulted in companies losing assets and preparing or reporting unreliable financial statements. One such example was a company called Computer Associates. It was a software company where the CEO stole company funds. He also frequently inflated the sales and earnings figures on the financial statements. The reason he was doing was so that he can prop up the stock price. So he gave wrong information, unreliable information to investors just because he wanted to personally profit from this. So he deceived investors. He was found guilty and was sentenced to 12 years in prison. He was also issued $8 million fine. Now, all businesses want to carry out efficient operations, which means companies want to reduce errors, wastage. They don't want work to stop. Now, errors in wastages cost business money. So to prevent that, they implement again checks and controls. Those checks and controls help them carry out efficient operations. Again, those are internal controls. Many companies have faced problems in their operation. One such company is Boeing. Now, Boeing has had major problems recently. In 2019, two of its planes, 737 MAX, crashed and killing hundreds of people, and which resulted in Boeing's $2.5 billion fine. In a more recent incident was where a door panel blew up in midair, causing confusion, causing all sorts of problems, and in midair, and risk the safety of the flight. Now that cost Boeing $160 million. Now those are just monetary costs. There are non-financial costs as well, such as Boeing's reputation has been damaged in this case. So therefore, internal controls are absolutely important for all businesses to protect their assets, to prepare reliable financial statements that investors have confidence in, and so that they can carry out efficient and effective operations without any errors or without any problems. So if a company wants to set up internal controls, what are the components of internal controls? The first component of internal control is control environment. Now this refers to the attitude of top management towards internal controls. If management values internal controls and is serious about these internal controls, and take strong actions where internal controls or where rules are breached, this leads to a very effective and strong internal controls. So the first element of internal control system is um, the control environment. This is the approach of the management, the top management towards how they value internal controls. So if they disregard the controls, employees will also disregard the controls. So management has the responsibility to implement a strong internal control system, and if rules are broken, they should take a proper disciplinary action against those breaking the rules. Now, the second element of internal control system is risk assessment procedures. Now, this refers to how a company identifies and responds to risks. Every company faces risks. Now, these risks must be identified and managed, and they are identified and managed through internal controls. Businesses such as bank usually have a risk management officer or an entire department dedicated to identifying and responding to risks in the business. The third element is information and communication. Now, all businesses need to collect information about what's happening in the business. Now, that information must be communicated to both internal parties and as well as external parties. The information they collect is financial information, such as accounting information. That information can also be operational informations. Now, to run the business properly, now regular reports must be produced about operational and financial information, so that those in the business, inside the business as well as outside the business, know how the business is being run. Now the next component is the control activities. Control activities are the specific procedures to reduce and identify and correct problems. So here the aim is so that we can prevent a problem from happening, and then if a problem has happened, we should be able to identify it through these control activities, and finally we can correct them. Now, some examples of that are reviews, reconciliations, trainings of employee, background checks on employees. Now, our main topic is of this video is control activities, so we will talk more about this very soon. Now, the last element of internal control system is monitoring of controls. Now, monitoring of controls refer to the fact that whether the controls are reviewed by the management or not. If they are reviewed, how often they are reviewed. Generally, controls must be reviewed at least once a year. Reason is because as the business operation changes, the internal controls should also change to deal with the new challenges that uh, business is facing. So therefore, the controls must be reviewed. It doesn't mean that once the controls are put in place, they are there written in stone. No, they have to be reviewed properly. So the components of internal controls are these: control environment, there are risk assessment processes, information and communication to inside parties and outside parties, controls activities, and monitoring of controls. We will talk more in detail about control activities. So we know that control activities are the specific procedures that prevent, identify, and correct problems. The problems are usually errors and fraud that happen in the business. So we use in control activities to achieve those things. Now, every process in the business must have control activities. These are the checks that prevent fraud and identify problems. Examples could be all processes, for example, sales or purchases, must have approvals, authorizations. You must train employees so that they can do their task properly without errors. And there should be regular reviews and reconciliations um, to detect problems. Those are control activities. Now, there are 6 control activities that apply to all most businesses, I should say. One, establishment of responsibility, segregation of duties, documentation procedures, physical and IT controls, independent checks of performance, and finally, human resource controls. All businesses should have these 6 controls in their processes and tasks or activities. We'll talk about each one of them in details. So first is the establishment of responsibility. What do we mean by this? Now it refers to the fact that a business must establish one person to be responsible for a particular task. Every task must have one person responsible for it. And control is effective when there is only one person responsible for a task. Let me give you an example to help you understand this. Imagine that 3 persons are working on a cash register at the same time. At the end of the day, when the physical cash is compared with the receipts or the report generated by the cash register, we find out that the $100 is missing from the cash register. Now the question is, who is responsible? Now we know that 3 people were working on this, but it is impossible to know exactly who the responsible person is. If one person was assigned to, say, this task of operating the cash register, we would know who is responsible for the shortage. If business is using computerized system, now establishment of responsibility is very easy because the person that is carrying out a transaction, say a sale or a purchase, usually logs in with their ID. So the system captures the ID of the person executing a transaction. So it is important that clear policies are available as to who approves what, and what kind of documentations are approved by who has access to certain types of information. An example of a establishment of responsibility would be that the CFO is responsible for authorizing or approving any checks over $25,000. So that's the first of the control activities. Establish one particular person as being responsible for a task. Now, the second one is segregation of duties. This is an important control. So, what is this? Segregation of duties refer to the fact that um, that to divide related tasks or duties among various staff in such a way that one person does not do all the tasks in the process. Now, the reason to divide tasks is so that one person cannot commit fraud and then is able to cover it up. That is the reason. Because if one person can do many steps in the process, so he or she can probably commit a fraud and then cover it up. Now, segregation of duties is absolutely important so that we can protect businesses from fraud. It reduces errors because if more than one person is involved in a in a process, that the second person will review the first person task and thus can capture errors. Now, an example of this would be, say, John authorizes the purchases. This is a so John has this function or this task. Bilal receives the purchases for the storage, and Tom makes the payment. So you see that the activities of a purchase is divided into many people, among many people. John, Bilal, and Tom. Each one of them have their own activity. Each one of them is probably unable to commit fraud because they are only responsible for one step of the process. So segregation of duties is absolutely important if a business wants to stop fraud and errors. The third one is documentation controls. Now, documentation control refers to the fact that every step of a transaction must produce documents. Now, that document is a proof of the transaction has happened. It also proves who was the person that approved the transaction or authorized the transaction. Now, documentations help businesses provide details of transactions for review and make accounting records more accurate and more reliable. Remember that documentations make it possible to review what exactly happened and compare that with the standard policies and procedures, and to check whether the policies and procedures were found. Now, I talked about Boeing and their operational problems. Boeing could not produce some of the documents related to the work performed on the door panel. And therefore, they couldn't identify what exactly happened and who actually worked on the door panel because there was no documentation involved. Now, therefore, the US government imposed strict inspection protocols on Boeing. Now, those strict protocols, inspection protocols, will cost Boeing more and more money. So it's important that every step of the transaction produces a document. An example would be John authorizes purchases of asset using a pre-numbered purchase order. So that's a document produced. Bilal keeps records of purchases using an invoice. Maybe Bilal is an accountant, so he or she keeps an invoice, and Tom keeps an asset registered document as well. So you can see every step of this process has a document involved. The fourth one is physical in IT controls. These controls are put in place by businesses to protect physical assets such as cash, goods, equipment, and as well as digital assets. Digital assets might be more important for businesses than physical assets nowadays. So, photos, videos, documents, books, and more increasingly, crypto assets are all digital assets. So, businesses would want to protect these assets, both physical as well as as well as digital assets. They want to protect them. They have to implement internal controls. So physical controls would be vaults, safety boxes for cash and document protection. They have to keep places locked. They have to restrict access to certain places through fences, barriers, or any use of cards or any other ways of uh, restricting access. So physical controls. Then there are ID controls, passwords, fingerprints, sensors, alarms, cameras, scanners. All these will come under ID control. Again, the aim is so that data is not stolen or changed, so that the physical assets of the business are protected. You remember we said that one of the objectives of internal controls is to protect assets of the business. So, implementing these controls should help them achieve that objective. The fifth control activity is independent checks of performance. Now, this means that it refers to reviews of operational, financial, such as accounting, activities and documents by independent persons. Now, independent checks means that documents, activities, tasks must be reviewed by independent persons. Independent persons are those that are not involved in doing the transaction. So we'll talk a little more about them soon. So the aim of this is to catch and correct errors and even fraud in accounting records and operational information. So these documentations produced by accounting or operational activities must be reviewed regularly so that we can find errors in them or even find fraud. Now, how do we do that? Businesses usually implement internal reviews. They keep for internal reviews, businesses have an internal department which is called internal audit. Now, their job is to review accounting records, to detect errors, fraud, ensure that policies are followed in the accounting department. They produce regular reports. If you remember, one of the components of internal controls is that there should be information communication and generation. So internal audit department produces those reports about the accounting department to review the accounting department and gives it to the management for decision making. Another independent check is by external, what we call external review. Now, these are people that companies hire from outside the company. We call them external auditors. Now, they review the financial statements of the company to check and see that the financial statement fairly present the financial position of a company. Now you remember we said that one of the objectives of financial statements is objective of internal controls is to produce reliable financial statements. So the internal review done by the internal audit department, which is inside the business, as well as the external review done by the external auditors, increases the reliability of financial statements because it will reduce inaccuracies and increase investor confidence in the financial statements. Finally, we have the human resource controls. Now, these controls are in place to ensure the company has staff with the right skills and the ability to meet current and future goals of the business. Now, every business employ people, and it is the people that do the work and implement policies and procedures. So companies need to have the right people to do the job so that they can ensure that accuracy is maintained and the policies and procedures are complied with. For example, to increase the reliability of financial statements and reduce inaccuracies, accountants must have the right skills and experience to be able to do that. So HR controls are implemented for two purposes. One is to increase efficiencies. Remember we said businesses don't want errors, don't want any work stoppage or wastage. They want improved operations, carry out smooth operations, and that can only happen if proper HR controls are employed, which means hiring skilled workers. There are regular staff trainings for to improve their skills, and the staff performance is regularly reviewed. HR controls are also put in place so that the business can detect fraud. So before hiring people, staff, there are usually background checks done so that they are hiring the right people. Employees are rotated from one job to another so that the new person taking the new role might be able to find errors and fraud. And finally, businesses have policies of mandatory time off. Again, individuals are sent on vacations, for example, so that another individual can take their role and might be able to find any errors or fraud this individual was covering. So, what is the purpose of internal controls? Well, internal controls give you protection, give business protections from errors, theft, fraud, increases, protects assets, increases the reliability of financial statements, reduces errors in operations. So it's sort of it is sort of protection for the business. Now that protection is not 100% assurance. Now remember that internal controls give reasonable assurance about meeting the objectives, which is to protecting the assets of the company, preparing reliable financial records and financial statements, and for the smooth operations of this. The assurance internal controls, no matter how well they are designed, is not 100%. They give you a reasonable assurance. Why not 100%? Now, there are many reasons. We call them, and those are the limitations of internal controls. So, internal control it inherently has some limitations that make it impossible to give 100% assurance that internal controls will detect fraud and errors and theft and lead into reliable financial statements or reliable operations. So let's discuss some of them. Now, one example of limitation of internal controls is collusion. Now, collusion means when two or more employees work together to get around internal controls. So, we talked about an internal control called segregation of duties. Now, segregation of duties is is needed so that fraud does not happen. Now, there's the series of tasks are divided among different people. If those people decide to commit fraud, we call that collusion. Now, internal control will never be able to detect that. So that's a limitation of it. Another limitation of internal control is the cost benefits, cost and the benefit analysis. So the cost of control activity should not be more than the expected benefits. So if you are implementing an internal control, you need to look at how much it costs to implement that internal control and what is it achieving and what are the benefits of that. So there is always that restriction and limitation of internal control. There is a human factor. We know policies and procedures are followed by employees. The internal controls are implemented by employees. So if employees are tired, negligent, or there is a confusion as to what to do, they don't have proper training, those employees will not be able to make make use of the or implement internal controls properly. So that is a limitation. Finally, the limitation is company size. Now, bigger companies can afford to implement segregation of duties, for example, can hire more than one employee for each related task. Smaller companies may not be able to afford to have segregation of duties, or even may not be able to have independence checks. For example, they might not have might not be able to afford internal audit system. So their financial statements might not be as reliable. So these are the limitations that are associated with internal controls. Now this brings us to the end of the video. Hopefully this was a helpful video. And if you like the video, make sure you click the like and subscribe to the channel and click the notification icon so that you are aware of the future videos. I hopefully you have learned this. Watch this video again and again, share it with friends, and I will see you in the next video.